the latest readings that we will get on inflation, potentially giving us a bit more clarity on what the Fed's next move could potentially be and what that timeline looks like for rate cuts. Now, this coming after the S&P 500 still continues to hold above that 5,200 level, not too far now from the all-time high. The Dow having the best week of the year last week, and we're now moving to the upside at the open, up nearly 0.3%. Let's talk about what to expect. We want to bring in Ben Emons. He is a NewEdge Wealth, a senior portfolio manager, head of fixed income and macro here. Ben, talk to us just about how much is really relying on the inflation prints, if at all, and how you think the market will likely react if we do get any sort of hotter than expected print.
So I was looking at the actual estimates of the inflation number, which is really narrow this time. It's like 20 basis points between the high and the low of that estimate from economists. And then I looked at the bond market, and they've priced it exactly to perfection of what the headline CPI is expected to come out at. And then you have nowcasting of CPI2, which is sort of like a real-time measure. That's also exactly in line. So if we price for perfection on CPI, then any type of surprise on that number, whether softer or harder, could lead to significant movement in interest rates particularly. Because previous segment I think was talk about, we keep buzzing every day about this rate cut. Yeah. And these inflation numbers obviously matter a great deal to that, because if this is a softer print than the previous three numbers, the calculus again changes. But if it's harder, the trend continues. And so I do think we're going to see some volatility around this number, whether it's soft or hard. I don't know if it's going to be soft or hard. That's a bit of a guess. Yep. The market is sort of trepidating, so there's not much signal that we're getting currently, so we're just waiting here.
So, at a certain point, we can deal with Wednesday when we get to Wednesday. I'm curious, speaking of what's happening in the bond market and sort of the action we've seen, along the Treasury curve over the last month, and really the way that price has perhaps led some folks to think about how they're allocating across asset classes. What's the state of play as we sit here mid-24? You still have 5% on the 2-year, still have plenty of opportunities to get something for nothing, right, if you want to talk about treasuries and cash. What moves have you been making, seen, been discussing most often as it comes to those allocations, which are now, we're a year into a state of play that people didn't think was last too long?
Yeah, the yield curve has actually been very flat and stable. The difference between the 2-year and the 10-year is something oscillating around negative 40 basis points. So you're not getting much reward from being really far out the yield curve. And as an investor, I take note of that, because at the end of the day, it's about risk taking in this case of like, if I don't get enough yield for the duration risk, so to speak, I may have to do different things. Now, I was talking to some of our clients and our advisors at our firm about thinking of duration itself, which is basically measuring the sensitivity of a portfolio when interest rate changes. You have to now think of diversifying duration, because we are in an environment, as I just described. If these data points keep throwing us off with volatility going one way or the other for interest rates, then you want to play it more safer. So let's say you want a duration of 6 years. You can do that, but you have to use different pieces of fixed income in that duration to get to 6 years, but have a low volatility portfolio. So what it comes down to is that you probably have to do more shorter maturity securities at this point. You not only get a better yield there, but it gives you low volatility. But then there's emerging markets, there's preferreds from that banks are issuing, there's structured credit, there's ABS. Those are all like securities I think are attractive in this environment. They've been positively returning and gives you a low volatility for the same duration.
And you mentioned emerging markets and made me think of something else you brought up in your notes about Milken last week. And it seemed like Rick Newman made this point in a column. Several other outlets made the point that everyone was cheering the U.S. economy. Everyone was super excited about investing in America. What do you make of that kind of consensus overweight to the U.S. in the context of global investments? There's a big story in the FT over the weekend about, will Europe ever catch up to the U.S. economy? And everyone's kind of contrarian, I think, signals are going off.
Yeah, it's a productivity miracle that we're dealing currently with, or at least we're anticipating it, with all this AI hype and the money is spent on it. Look, we have a stronger economy because I think really that in the early days of the pandemic, part of the country just reopened without having any kind of acceptance of the pandemic being there, so to speak. And I think that was really that mattered today even. and which is all the Sun Belt states. And then we got the stimulus, not just the spending stimulus, but the Infrastructure Act and the Inflation Reduction Act. That sounds political, but it does have a real impact on the economy currently. That's actually driving the productivity to an extent. I think this is why people are looking at the US of this difference of growth versus Europe that does not have as much productivity growth currently. And the lawmakers in Europe are concerned that productivity growth is too slow. And I think this is why people like the US. But to sustain it, this was the other big theme at the Milken conference, like everybody wants a rate cut. Because if we don't cut rates at some point, then we cool off the economy too much and that productivity miracle may disappear. So I think the enthusiasm for the US will remain. And it will remain well into the election. After that, we'll see. But I do think it's the outperforming economy.
And speaking of enthusiasm, let's talk about the meme stock move that we're seeing here this morning, because Miles and I were talking about this massive run-up that we've seen in GameStop, a lot of it on the heels of this tweet that we got out from Rory and Kitty over the weekend. But I'm curious from your perspective, this hype, this mania that we're starting to see resurface here with some of these meme trades. Is it going to play out differently this time? Is some of this, do you think, of maybe a bit more staying power than what we saw a few years ago?
Well, on the one hand, the meme stocks were always interesting about the reopening of the economy, like that company that you mentioned. I mean, the fact that malls went open, everybody could go back into a GameStop store, and it allowed GameStop actually to have access to capital markets and have capital and then invest in its business and recover. That was part of that initial meme stock, and then it became speculative and everybody jumping on it. I think this latest move, I guess, is again enthusiasm of taking risk and some level of speculation as we're sitting here sort of in a low volatility environment waiting for any kind of signal from the Fed or the election or the economy. And it drives people to potentially trading again. So I'm not surprised, right, in a way. This is one company, you get a bunch of other of those. Are they investable stocks? I think you need to do your homework on the companies in and by itself. I would advise, we're not analysts on it, but I think broadly speaking that it will always be part of our markets now. People have learned to trade. There's enthusiasm about taking option trading on, and all these retail brokerage firms offer that, right, in order to trade options, and people look at it as an income generating too. So I think that's part of what's playing out here.
As we enter the 5th year since the pandemic started, to sit here with 5% rates and talk about a low volatility environment, it's really amazing how far we've come. It feels like we're back in 1920, pre-pandemic to some extent. Ben Emons, always a great conversation. NewEdge Wealth Senior Portfolio Manager. Thanks for stopping by.